Hey everyone, welcome to the Deep Dive. If you're looking for an edge in understanding the market, remember to like and subscribe to the Stock Analytics AI YouTube channel. Our members get priority deep dives on specific tickers, and today, well, we're giving you a taste of that in-depth analysis. By the end of this deep dive, you should have a much clearer picture of whether a coastal real estate giant like AvalonBay Communities can continue building value amidst, shifting economic tides, or if its premium portfolio is maybe exposed to the tides of change. Today, we're taking a comprehensive look at AvalonBay Communities, REIT. That's ticker symbol AVB on the New York Stock Exchange. Now, this company isn't just another name in real estate. They're a leading residential real estate investment trust, a REIT. And they've been a really significant force in the U.S. multifamily housing sector for, over 3 decades now. Our mission for you today is to explore if AvalonBay can truly keep building value, or if that premium portfolio is maybe vulnerable to larger economic shifts. We're drawing insights from data as of June 17, 2025, and using a reference share price of $206.18 from June 13, 2025.
That's exactly right. And this isn't just about, the ticker price. It's about getting a really comprehensive look into AVB's operational strengths, their strategic direction, and overall their financial health. We want you to walk away with a nuanced understanding of where they stand.
Okay, so we're going to tackle this deep dive in 2 main parts. Part 1 will cover Chapter 1, business analysis, then Chapter 2, management evaluation, and Chapter 3, financial analysis. Then, in Part 2, we'll move into Chapter 4, market sentiment, Chapter 5, ownership structure, Chapter 6, risk assessment, and wrap it all up in Chapter 7, conclusion. All right, let's jump straight into Chapter 1, business analysis. So when we talk about AvalonBay, okay, we know they own apartments, but what's the deeper story behind their core business model? How do they really create value?
Well, AvalonBay operates on a very well-defined model, one they've honed over time. It's centered on generating long-term shareholder value across the entire life cycle of multifamily real estate assets. So their core activities involve development, building new communities, redevelopment of existing ones, strategic acquisitions, managing properties efficiently, and then selectively selling off assets that maybe don't quite fit their long-term goals anymore.
Right, and their main revenue stream obviously is rental income. What's interesting, I think, is how they segment their operations. You've got established communities. These are the stable cash-generating properties, right? Predictable income. Then there are other stabilized communities, newer properties, recently completed and leased up. And finally, development or redevelopment communities. This is their future growth pipeline. More capital intensive, but it shows where future value might come from. Helps us sort of separate the consistent cash flows from those growth drivers like FFO and NOI you mentioned.
Precisely. And their core product is, renting high-quality apartment homes. They call them distinctive apartment communities. Think premium living spaces, really desirable urban and suburban coastal markets. They're targeting renters in high-wage sectors, people looking for convenience, quality, a certain lifestyle, especially where buying a home is just, incredibly expensive.
Something I found surprising, or at least an interesting evolution, is their strategic move into build-to-rent, BTR, specifically townhome communities.
Yes, that's a significant shift.
It seems like a direct response to that millennial trend, right? Wanting larger, more suburban-style rentals, but still with professional management could be a big new growth area.
Absolutely. And their market position, their scale, it's genuinely impressive. AvalonBay is a leader in the U.S. multifamily REIT space, 30-year track record. They own or have interests in almost 290 communities, over 88,000 homes, plus another 19 properties under development. This huge scale, strategically focused in 12 states and D.C., mostly vibrant coastal regions, gives them, big operational efficiencies, deep local knowledge, and a really powerful brand.
And their value proposition, it seems like it serves 2 groups. Creating a better way to live for residents, great experience, prime locations. But it also delivers for shareholders, right? Superior long-term risk-adjusted returns through those premium rents and high occupancy. It's kind of a symbiotic relationship.
It really is. And looking at the wider industry, the U.S. multifamily market seems to be at a, let's say, positive turning point in 2025. Especially in AvalonBay's core coastal markets, demand looks strong. J.P. Morgan Research, for instance, they're projecting FFO growth around 3% this year, accelerating to nearly 6% in 2026.
Oh, okay.
And that outlook is partly driven by a big slowdown in new apartment deliveries that peaked back in 2024. Plus, you have this robust structural demand because home prices and mortgage rates are just so high, it pushes people towards renting.
Yeah, makes sense. Now, competition. AvalonBay isn't alone out there. They're up against other big players, other large-cap residential REITs like Equity Residential, Essex Property Trust.
Definitely a competitive field.
So how does AvalonBay stack up? Their market cap is huge, nearly $30 billion, one of the biggest. And a key number I saw was their normalized return on invested capital, ROIC. It's 4.86%. That's noticeably higher than, say, Essex Property Trust at 3.77%.
Right. And that's not just a number. It suggests they're more efficient in how they use capital. They're consistently getting more value out of each dollar invested compared to some peers. That points to real expertise. We also have to talk about the regulatory environment. It's a major factor, especially in places like California, New York, Massachusetts. Think stringent rules. Rent control or stabilization, really lengthy and costly zoning and permitting can take years, plus tough environmental regs.
So that sounds like a headache.
It is. It increases their costs. But it's also a double-edged sword because those same regulations create huge barriers to entry for new competitors. It kind of protects their existing portfolio from too much new supply.
Ah, okay. That leads us to their protective moat then. These barriers sound pretty formidable.
They are. You've got extreme capital intensity. Land costs can be 4 or 5 times higher in their coastal markets. Construction costs are rising. Those regulatory hurdles we mentioned can be 40% of development costs.
Wow.
Plus geographic limits, oceans, mountains. You can't just build anywhere. So for a new player to try and replicate AvalonBay's scale and operational know-how, it's incredibly difficult.
Makes sense?
Their brand strength is another edge. That 30-year history, the exceptional living experience focus, it attracts those affluent renters, and that directly supports their ability to charge premium rents and keep occupancy high.
And beyond the brand, they've got cost advantages from that sheer scale, right? Over 88,000 homes.
Exactly, bargaining power with suppliers. Plus, they're using technology AI for leasing tasks, their neighborhood operating model for efficiencies. It all adds up.
Right.
Now, you don't really have traditional network effects like in tech, but there are moderate switching costs for residents. Moving is a hassle, financially and logistically. So if residents are satisfied, and AvalonBay focuses heavily on that, using net promoter scores, they tend to stay put. That means lower turnover, more stable revenue, and lower turn costs for AVB. They capitalize on that inertia.
Okay, this is where it gets really interesting for me. AvalonBay's was competitive advantage, maybe. That sophisticated in-house development and redevelopment platform.
I'd agree, it's absolutely central.
They're not just buying buildings, they're manufacturing growth. They find these accretive development opportunities, meaning it costs them less to build than the finished property is worth on the market.
That's the key. They create value directly.
And you gave some numbers on that spread.
Yep.
Development yields around 6.5% versus buying or selling existing properties at maybe 4.9% to 5.2% cap rates.
That's right. That 150 basis point premium, that's pure value creation. And having that capability fully integrated in-house, it's very, very hard for competitors to copy effectively.
Okay, fascinating. Before we get into the leadership and the numbers, just a quick break here to give a shout out. Remember to like and subscribe to the Stock Analytics AI YouTube channel. And hey, members, don't forget you can add stock suggestions for future videos right there in the comments. We definitely see those and pick them up. All right, let's move into Chapter 2, Management Evaluation. Who's steering the ship at AvalonBay, and what's their track record look like?
Well, the leadership team is quite seasoned. The president and CEO is Benjamin W. Schall. He came on board as CEO in 2022. He brings a lot of leadership experience from other public REITs. His background, especially in development and mixed use, seems very relevant to AvalonBay's strategy right now.
And we saw a good example of their management during the pandemic, right?
Yeah.
Their response to COVID-19 in 2020.
Yes, that was quite telling. They acted swiftly, very prudently. They pulled their 2020 outlook, drew $750 million from their credit facility just to be safe on liquidity. They paused new development starts, cut non-essential spending.
Smart moves.
Really demonstrated strong balance sheet focus and operational flexibility in a crisis. They also supported stakeholders, waived late fees, flexible renewals for tenants, emergency paid leave for staff.
Okay, so operationally, they handled that well. Now, what about communication ethics? They talk about highest standards of ethical conduct, A+ BBB rating.
On the surface, yes, that's the stated commitment. Their corporate HQ does have that A+ rating.
But T, here's where it gets really interesting, maybe even concerning. A deeper dive into the Better Business Bureau records. It shows 247 customer complaints in the last 3 years. Over 100 just in the last 12 months.
That's a lot.
Yeah, and they're not trivial complaints. We're talking billing errors, hidden fees, maintenance issues going unresolved, reports of unprofessional staff. And this seems backed up by data from comparably.com too, where AVB ranks below competitors on CEO ratings, culture, and especially customer service.
So there's a definite say-do gap here.
Seems like it.
And that raises an important question, doesn't it? How does a company aiming for a premium brand, this exceptional living experience, end up with so many customer service issues? It's a tangible risk. That operational weakness could seriously damage their brand reputation over time. If the experience doesn't match the price tag, that premium pricing power could erode. It's something for investors to watch closely.
Definitely. Okay, moving to capital allocation. How does management decide where to put the money?
They seem to have a very dynamic, disciplined strategy here, focused on optimizing the portfolio. They use what's called capital recycling. Basically, sell off older or non-strategic assets and reinvest that cash into higher growth opportunities.
Like those recent deals.
Yeah.
Selling 8 communities for over $700 million, buying 6 others for around $460 million.
Exactly. And it's tied to a clear strategic shift, too. They're aiming for 80% suburban properties now and pushing into those expansion regions. Texas, North Carolina, Colorado, about 25% target there.
Right.
And the main place that recycled capital goes, back into new development. They budgeted over $1 billion for 2024, $1.6 billion planned for 2025. Development is clearly management's primary tool for value creation.
Okay. And returning capital to shareholders. It's mainly the dividend, right?
Primarily, yes. They have a very consistent history of quarterly payouts. They've increased the dividend for 3 straight years now. The Q2 2025 dividend was $1.75 per share. That's $7 annualized. Give you about a 3.4% yield at the current price.
And buybacks. Not much happening there.
No significant share buyback programs recently. Dividends are the preferred method.
Gotcha.
Now, a point of caution on that dividend. The payout ratio is pretty high. Somewhere between, say, 84% and nearly 90% of earnings.
That is high. How does that compare?
It's notably higher than the sector average, which is closer to 74% of AFO-adjusted funds from operations. AFO is really the better measure of distributable cash for a REIT. So this high payout means they're returning most of the profits, leaves less cash for reinvestment, and makes future dividend growth really dependent on executing that development pipeline successfully and growing FFO.
Okay, something to keep in mind. What about return on invested capital, ROIC? We touched on this earlier.
Right. They perform well here. Morningstar puts their normalized ROIC at 4.86%, significantly better than Essex Property Trust's 3.77%.
And Alpha Spread had it slightly lower, but increasing?
Yes, 4.5%, but with an upward trend. And connecting that back, this superior and improving ROIC is a strong quantitative point for the bulls. It really shows management is deploying capital efficiently, more so than some key competitors.
Okay, so how does all this strategy and management activity translate into the actual financial numbers? Let's dive into Chapter 3, Financial Analysis.
First off, their market cap, around $29.35 billion. That firmly plants AVB in the large cap category. They're an influential REIT, and that scale gives them advantages, right? Better access to capital markets, more liquidity, the financial muscle for those big development projects we talked about.
Makes sense. What about revenue growth, looking back 5 years or so?
It shows resilience, but also the cyclical nature of real estate. There was a slight dip in 2020, the pandemic, but then a strong rebound, 11% growth in 2022. Then it moderated to healthy growth, maybe 6% in 2023, 2024. Last 12 months, revenue growth is around 5-6%, hitting nearly $3 billion total. Over 5 years, that's about 25% total growth, or a 4.6% compound annual rate. Pretty steady.
And profit margins, how do those look?
Consistently strong. Gross profit margins are typically in the low 60% range, maybe 63-64%. Operating profit margins around 31-32%. Now, what's interesting and sometimes confusing with REITs is the net profit margin. It's often higher than operating margin, maybe 37-38% for AVB.
Why is that?
It's due to GAAP accounting. Non-cash items, mainly gains from selling properties, get included in net income. That's why analysts really focus on FFO and NOI for REITs. They give a clearer picture of the actual recurring cash generation from operations.
Okay, got it. What about free cash flow?
Looking at traditional free cash flow over 5 years, it can look pretty volatile, even a negative growth rate sometimes.
Why the volatility?
It's because REITs that are actively developing, like AvalonBay, have significant capital expenditures related to that growth. Traditional FCF subtracts all CapEx, so it's less relevant here. What matters more is that their operating cash flow has been consistently positive and growing. And again, AFFO, adjusted funds from operations, is the better metric for the cash they actually have available to distribute after maintaining their properties.
Right. Same story for earnings consistency. GAAP EPS looks volatile.
Exactly. GAAP EPS can swing quite a bit year to year, again, largely because of the timing and size of property sales. Core FFO per share, which is a non-GAAP metric they report, is much more meaningful for understanding their consistent earnings power and what supports that dividend.
Okay, shifting to financial stability. Debt levels. Balance sheet health.
They run a pretty conservative balance sheet, generally well managed. Their debt-to-equity ratio is around 0.68 or maybe just under 70%. That's considered reasonable for a capital-heavy business like a REIT. And the trend is good. It's actually declined over the last 5 years.
How much debt total?
Total debt is around $8.3 to $8.5 billion, but they have strong investment-grade credit ratings A3 from Moody's, A from S&P. That gives them flexibility and good access to debt markets.
What about the current ratio? You mentioned it's low.
Yeah, consistently low, often below 0.5. In most sectors, that would scream liquidity risk.
But not for a big REIT.
Not necessarily for a large, established one like AVB. Their rental income is incredibly predictable, very stable month to month. They generate substantial operating cash flow, and crucially, they have a big revolving credit facility like $2.25 to $2.5 billion available if needed. So for them, a low current ratio is more a sign of efficient cash management than distress.
Okay, that makes sense in context. And finally, just recapping the dividend.
Right. Stable, reliable track record. Long history of payments, 3 consecutive years of increases. Currently $7 per share annually, yielding about 3.4%.
But the growth rate has been modest.
Yeah, around 2% compound annual growth over the last 5 years. And that circles back to the high payout ratio. Limits room for bigger heights. Future growth really hinges on growing that FFO per share.
Okay, we've covered the business, the management, the financials. Let's turn our attention to the market itself now. How is Wall Street actually feeling about AvalonBay's prospects? This brings us to Chapter 4, Market Sentiment. What's the vibe out there?
Generally, the sentiment seems neutral to maybe cautiously optimistic. The consensus rating from analysts tends to hover around hold or maybe moderate buy. It suggests they see AVB as a solid, stable company, but perhaps lacking a strong near-term catalyst for big gains, probably because of those broader economic headwinds we've discussed.
What about price targets?
The average 12-month target is somewhere in the $230 to $236 range. From the current 236 level, that implies maybe 12-15% upside. But, individual analyst targets vary quite a bit, from around $213 up to maybe $262. There's a decent spread. We've seen ratings from Scotiabank, Mizuho, Morgan Stanley. BMO recently downgraded them slightly.
In recent news, anything shaking things up?
Mostly routine stuff, really. Standard corporate comms, dividends, conference appearances, earnings reports. Their Q1 2025 FFO did beat expectations, which was positive. Revenue momentum looked okay. The general narrative you hear about the sector is that 2025 is kind of a transition year. Expectations are for recovery and stronger rent growth maybe later this year or next. So AVB is generally portrayed as stable, well-managed through this period.
Okay. What about market indicators? Short interest.
Short interest is notably low, somewhere between 2% and 3.3% of the float.
And that's low compared to peers.
Yeah, it's below the peer average of around 4%. The days to cover is also manageable, around 4.5 days. What this tells you is there's limited perceived downside risk out there. The market isn't seeing a strong reason to bet against AVB right now. No compelling short thesis seems to exist.
And the stock price relative to moving averages?
Well, at around $206, it's trading very close to its 50-day moving average, which is just over $204. That suggests kind of a short-term balance point, maybe consolidation. No strong push either way in the immediate term.
But the 200-day?
That's different. The stock at $202 is trading below its 200-day moving average, which is up near $213.50, and that's been a persistent trend.
So technically bearish long-term.
From a pure technical standpoint, yes, trading consistently below the 200-day is often seen as a bearish signal for the longer term. But for value investors, this can be interpreted differently. It might mean the stock is simply out of favor right now, potentially offering a better entry point if you believe in the underlying long-term fundamentals. It depends on your perspective.
Okay, interesting dynamic there. So what does this all mean for who actually owns AvalonBay shares? Let's dig into Chapter 5. Ownership structure. Who holds the stock?
It's overwhelmingly institutional owners. Really high concentration. About 92.6% of the shares are held by institutions, over 1,500 of them. And the top 3 are the usual suspects: Vanguard, BlackRock, and State Street. Together, they control roughly 34.5% of the company.
Wow, over a third just between those three.
Exactly. And this kind of ownership, often referred to as sticky capital, meaning it's held in long-term funds, index funds, ETFs, it provides a very stable shareholder base. It can help reduce day-to-day volatility.
What about insiders,
Yeah.
management ownership?
That's relatively low, actually. Only about 0.42% of shares are held by insiders. Now, you might see data showing a slight net positive in shares traded by insiders over 12 months. But you have to be careful there. That often includes things like stock grants, which aren't open market buys reflecting confidence at the current price.
Okay, so what is telling from insider activity?
What really stood out was a cluster of discretionary open market sales back on March 1st, 2025. CEO Benjamin Schall, CFO Kevin O'Shea, COO Sean Breslin, they all sold shares on the open market at $226.18 per share.
C-suite selling at that price.
Right. So if you combine the lack of significant open market buying by insiders with these coordinated sales by top executives, it suggests maybe that management didn't see the stock as deeply undervalued when it was trading around $226. It acts as a kind of soft bearish signal for investors.
Okay, so summarizing ownership. Highly concentrated among a few huge institutional asset managers.
Yes, which reinforces AVB's status as a core holding in lots of large cap funds and REIT ETFs. That provides a certain level of built-in demand for the stock.
But there's a flip side to that concentration.
There is. It means that if one or two of those giant asset managers decides, for strategic reasons unrelated to AvalonBay itself, to reduce their overall exposure to REITs or just trim their AVB position, that could lead to significant selling pressure on the stock, even if the company's fundamentals haven't changed. It's a potential risk tied to that concentrated ownership.
Right, good point. Okay, let's try to pull together the core challenges and opportunities. Let's break down the classic SWOT analysis for AvalonBay in Chapter 6. Risk assessment, strengths first.
Okay, strengths. We've hit these, but to recap, a premium portfolio in high-quality, supply-constrained coastal markets. That value-creating development platform, their engine for growth. Strong brand and scale, attracting good tenants and giving efficiencies. A conservative balance sheet, investment grade, flexible. And experienced management, disciplined, handled crises well.
Okay, but every company has its limitations. What are the weaknesses?
Geographic concentration is one. Being heavily focused on those coastal markets exposes them more if those specific regions face downturns or new, tough regulations. That high dividend payout ratio we discussed limits the cushion for growth, makes future hikes dependent on FFO. The operational execution gaps that disconnect on customer service is a real brand risk, needs addressing. And the low current ratio, while maybe okay for a REIT, still means they rely heavily on predictable cash flow and those credit lines working smoothly.
Gotcha. What are the opportunities ahead?
Strategic geographic expansion is key. That pivot to Texas, North Carolina, Colorado, and the suburban focus. Big potential there. The build-to-rent, BTR sector, tapping into that demand for larger rentals seems like a smart move. Durable demand from just plain housing on affordability. High home prices and mortgage rates create a long-term tailwind for quality rentals. And favorable supply dynamics as new construction slows down overall, that should give established players like AVB more pricing power in the coming years.
Makes sense. And finally, the threats. What keeps them up at night?
Intense competition is always there, fighting for deals, for development sites, for the best tenants. An economic slowdown is a major threat. Could weaken rental demand, lead to more delinquencies, and regulatory risk is constant, especially in their core markets. The potential for expanded rent control, tougher zoning, environmental rules, that's always looming.
Okay, and stepping back, those macroeconomic factors loom large, right? Inflation, interest rates.
Absolutely. This higher for longer interest rate environment we seem to be in, it's not abstract. It directly increases borrowing costs for every new development, every acquisition, makes projects less profitable potentially. And rising rates also pressure valuations across the board by increasing the discount rate used to value future cash flows. It's a definite headwind.
And you mentioned another interesting twist, geopolitical factors. Specifically, those U.S.-imposed tariffs from 2025 on construction materials.
Yes, things like imported steel, aluminum, lumber.
So the direct impact is obvious. Higher construction costs. That squeezes the profit margin on new developments, that accretive spread we talked about.
Yeah, exactly. Makes their main growth engine less powerful, potentially.
But there's a secondary effect.
There is, and it's kind of paradoxical. Those same tariffs make it harder and more expensive for all developers, including AVB's competitors, to build new supply. So, by constraining overall new housing supply, the tariffs inadvertently strengthen the competitive position and pricing power of AvalonBay's existing massive portfolio.
Huh. So it hurts their development economics, but helps their existing properties.
Precisely. It's a really delicate balance for investors to weigh. Which effect is stronger? It's a key question.
Fascinating. Okay, so what does this all mean for you, the learner? Let's bring it all together for our final thoughts in Chapter 7. Conclusion.
All right, let's synthesize. The bull case for AvalonBay rests on several strong pillars. You've got that sleep well at night portfolio premium assets in great coastal locations, historically delivering superior returns. You have the proven value creation engine via their in-house development, generating those higher yields. The fortress balance sheet, conservative leverage, investment-grade ratings, financial flexibility, experienced management that's shown discipline and crisis management skills. And that favorable long-term demand driven by persistent housing unaffordability. It's a solid foundation.
Okay, but then there's the bear case. What are the main arguments against investing right now?
Macroeconomic pressure is a big one. Those elevated interest rates, construction cost inflation made worse by tariffs, they threaten to squeeze development returns. The high payout ratio definitely limits future dividend growth potential and leaves less cash for reinvestment. Those operational inconsistencies, specifically the customer service gap, pose a real risk to their premium brand. And finally, valuation. At the current price, it might just be fairly valued, perhaps not offering a compelling enough margin of safety for some investors, given the risks.
Oh, okay. And your educational DCF analysis pointed to an intrinsic value range.
Yes, our educational discounted cash flow model estimates an intrinsic value somewhere between $220 and $245 per share for AVB.
All right, so comparing that to the recent closing price of $206.18, it suggests the stock is trading at a modest discount, maybe 6% to 16% below that estimated intrinsic value range. And Wall Street targets point to similar upside, maybe 12–15%.
That's right. And in our view, that modest discount seems, well, warranted. It reflects those significant macroeconomic and geopolitical risks we've hammered on. Look, AvalonBay is undeniably a high-quality company. Strong portfolio, proven management. The ultimate investment decision for you really boils down to your confidence level. Can management navigate these headwinds effectively? What's your long-term view on the economic health of those prime coastal markets? For long-term investors, today's price might be a reasonable entry point. But if you're more concerned about near-term risks, maybe that margin of safety isn't quite wide enough yet.
So here's a final thought for you, the learner, to chew on. In a world where buying a home in prime locations is just increasingly out of reach for so many, will AvalonBay's strategic pivot into build-to-rent townhomes fundamentally change how we think about long-term rental living? And just how durable will that tailwind truly be? Something to consider. And that wraps up our deep dive for today. We covered a whole lot of ground, didn't we? From AvalonBay's business model, its financial health, market sentiment, ownership, risks, opportunities. Whew! We really hope you feel much more well-informed on AVB now. If you found this deep dive valuable, please do us a favor. Like this video and subscribe to the Stock Analytics AI YouTube channel. And remember, premium members get that exclusive access to request their own deep dives.
And the important reminder, this analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thank you so much for joining us on this deep dive. We really enjoy exploring these complex topics with you, and we'll be back soon with another fascinating subject to unpack. Until then, stay curious and keep learning.